So I invited my friend Jeremy Lyman to come into Wheelhouse and talk a little bit about the current real estate market. A lot's been going on, especially with changing interest rates, not only on a national level, but a local level. And two different areas are acting very different, commercial and residential. If you like this content and you want to see more, go ahead and click and subscribe. So here with Jeremy Lyman from Cottonwood, which is a real estate firm based out of Utah, right
Yep.
here in Salt Lake City, right? And what we wanted to do is just kind of have a casual conversation about real estate. Real estate is something that I think is on everybody's mind, right? Because there's been some big gains in real estate kind of during the COVID times, which was a little bit unexpected. Then interest rates rose and everybody's like saying, hey, what's going on with the real estate market? And so being how you're, I guess you could say 100% of your working time is in real estate,
hmm
specifically in commercial, the space. I wanted to kind of just get a feel for maybe if you wouldn't mind explaining what's been happening in the commercial space over the last 12 months, 18 months
Yeah.
that you guys have seen, and then we'll kind of pick it up from there.
Yeah. No. So, I mean, interest rates, I mean, just debt in general is just the underpinning of commercial real estate. I mean, whether you're a big entity, middle size like us, or small, most people access debt in terms of owning investment properties. And so when those interest rates are moving, whether up or down, it has the effect on demand for those properties and of course the values of them. So we were in such a depressed interest rate environment for so long where effectively debt was just at zero. I mean, just cheap. And so really just gave anyone access to come in and be able to buy properties at such historically cheap debt levels that it just brought so many people in, which ended up driving prices so high. Obviously, inflation came in a very strong way 18 months ago, thereabout, of strongest inflation we've seen in decades. And so that's what triggered, obviously, the Fed to start raising rates. And so the question sometimes is, well, why? What if interest rates are going up, why is that having a negative impact on the values of commercial real estate? And it just goes back to that point I just made, which is when people are accessing debt, just like if you're owning your own investment property or even take it to your own primary residence, how much your debt or your mortgage is going to take an impact on how much you can pay or are willing to pay. And so for what is rates are going up, that debt becomes more expensive. And what that does is that cools off kind of the activity of how many buyers and sellers are coming to market. And so when there's not a lot of transaction activity, that means prices are probably going to start to soften until you feel like you're on more stable ground. So what was interesting about this last cycle is, I mean, the Fed raising interest rates isn't anything out of the ordinary,
Right.
but them raising rates as high and as fast as they did is out of the ordinary. Going from zero, we're currently to 5.25%. We did that in the course of, I think it was 14 months.
Yeah.
And it was significant was because really what it did is it pushed all the major transactions, the buyers and the sellers too, that could hold on just to the sideline, holding on to say, hey, we're waiting for more stable times, which we think we're now starting to enter, that the Fed is done raising. But yeah, it's that cyclicality of kind of, okay, we were in low interest rate environment for so long that benefited well. We've now gone through this significant correction with rates increase. And there's other factors too, taxes, insurance costs, but it mainly driven by the reset in values driven by interest rates. And that, yeah, like any cycle, we will get on the other side of it. But the other key impact I think people sometimes kind of conflate to is to say, how have home prices stayed so elevated where
Right.
commercial real estate's been more volatile? And it's because you typically can't access 30-year debt in commercial real estate. Whereas so many people right now are locked into a 30-year, 3% or thereabouts, and they're not moving. So that's really keeping home prices so elevated along the fact that there's not enough inventory in homes. Whereas commercial real estate, you're typically going out 10 years of debt, and that's just laddered throughout the economy. So you don't have that luxury of saying, oh, I'm 5 years in, interest rates go up. If I was on a 30-year mortgage and I had 25 years left, that's fine. I can weather that.
Right.
But if I only have 5 years left or 2 years left, I have to start planning for when that thing has to be refinanced or if I have to sell. So that's why there's more volatility in the commercial real estate market, because debt doesn't get pushed out as far.
Right.
Yeah.
So at the end of the day, I mean, it's still a supply and demand issue, right? Like just there's not as many buyers that can afford to buy property when the rates are high, right?
Or want to. Yeah.
Yeah, or want to.
Yeah.
So when we talk about appraisals, right? So let's say that, somebody's got a commercial building or they're invested in commercial real estate through one structure or another, right? And then all of a sudden they're seeing like appraised values or NAVs, net asset values, being dropped down.
Yeah.
Is that, I mean, do you feel like that's necessarily reflective? Because we all know in real estate, you don't realize that price until you sell it,
That's
right?
right.
But it's almost like on the statements, because of the way accounting is done, because the interest rates went up, we have to say it's worth less, even though the property may be perfectly healthy.
For sure. And so that's what was so interesting about this cycle is when rates started going up, because you talked about it just a minute ago, that before the Fed started going to work with raising rates, you really saw this kind of just final just boost to commercial real estate because again, rates were so cheap, stimulus was dumped into the economy,
Yeah.
and there was such demand for just whether it was housing or just commercial real estate, that it went from kind of like stable growth to just really like hyperbolic. And we've now seen that start to unwind, but it's the same thing on the way going up. It's tough to kind of capture like, well, we think it's worth this, but you don't know until someone actually signs that letter of intent or that contract. And it's the same thing on the way down is when really transactions cool off and there's nothing trading, the people that are striking that at net asset value or delivering that appraisal, it's driven by comps. It's to be able to say, okay, you have this property that we are looking at similar properties in the area that have sold recently and that we can help determine an approximation. The problem was last year is you just didn't have any comps because nothing was being bought or sold. So there was kind of this embedded assumption that, well, if not much is selling in this city or this neighborhood or this area, that our assumption is that values are softening until you can develop that price discovery by saying, okay, deals are starting to get put on the market. We can now see, okay, that one just sold for this, that one just sold for this. But in the absence of comps, you're right. Appraisals are tough to be kind of relied upon in terms of their accuracy.
Right.
Yeah.
So I mean, you mentioned there's been a cooling off, right? People went to the sidelines. Now the Fed has kind of slowed down. They're not
Yeah.
as aggressive. They may even, I mean, they're talking about possibly even reducing the interest rate, possibly even in this year. So when the Fed starts to kind of roll over the top and say, okay, we've kind of maxed out, hopefully, right? What do the typical real estate guys think about that as far as timing and what you're foreseeing that could be an opportunity in the future?
Totally. And so again, it's the old worn out term of real estate is the cycle you're in. Is this we go through these cycles. And so the last cycle, 2008, 2009, which was just the great financial crisis, and it did a wallop to commercial real estate that many people remember. And then you saw kind of the settling in 2010, and then you saw a decade plus of just solid, sustained performance in well located, well operated commercial real estate. Then we get to this point of post COVID and kind of that final really white hot kind of just appraised value or evaluations that went up. And so now you've seen that kind of start to cool off. So to your point, we are in the camp too. The assumption is, hey, the Fed is done raising. Now the question is, when do they start cutting? And we hear 100 different things. It's going to be, it was supposed to be in March. Now that's kind of, people think it's not. And then is it May? Is it June? Is it September? So we don't know. But what we do believe is because at the end of the day, we're all trying to read information and allocate capital based off of that. Because that's all we're doing is we're trying to understand kind of where do we think opportunities are today and where are they headed. And so for us, that first stage is, okay, if they're done raising, that sets in kind of that first kind of turn of the page, which is stabilization. If values can start to stabilize, then, and we do believe that, okay, that we're starting to feel like there's enough information saying that we think we're approaching that or even maybe entering it now, where again, values don't drop as much or start to really level off. Now, what changes is we're not looking for something all of a sudden where it takes back off. It's not a V-shaped recovery. It's not like we were valued here, we dropped down to here, and then 2 months later, we're back up to here. And so what we think is when they do start cutting, because right now what you're starting to see is even with stability starting to take hold, you're starting to see more deals come on market. You're starting to see more activity. It's not a ton, but it's coming out of that deep freeze we were in last year.
Yeah.
When they start cutting, well, and it's good. We're going to see probably just nominal, a 25 basis point cut here and there. But the idea is that kind of signals, okay, we've gone from a rising interest rate environment to a stable interest rate environment to a declining interest rate environment. And a declining interest rate environment historically bodes well for commercial real estate. And so as you see them start to cut, you see more and more people or entities jump into commercial real estate, which starts to revive its activity and probably starts to bring its prices back up in a positive way.
Yeah.
But this is over the course of months, if not even sometimes years. And that's, I think, what sometimes want to say is like, oh, is this thing going to, it's not publicly traded private commercial real estate. It's on a much more kind of laggard, kind of impact in terms of what's happening in the macro economy. So,
And I think something you brought up is really interesting, right? Because you mentioned that we had been in such a low interest rate environment for so long that you had a decade plus of just constant increase.
yeah,
And then we hit the COVID, which things became white hot. And I think what actually happened, so let's just call it, there was 12, 13 years of that.
yeah,
And a lot of people had forgotten that real estate does have cycles, right?
totally.
We heard it all the time, whether it be on TV commercials or other types of advertisement. Real estate never loses money or never goes
Not
down.
true.
It definitely not true, right? It's just that after 13 years, a lot of people forget that there
Totally.
are these cycles, which can be healthy because it can produce buying opportunities when you come out on the other side, right? If you're patient and
Yeah.
and a good investor. So I think that that's super interesting. Let me ask you this. Um, you know, like you mentioned, there's different areas of real estate, right? You've got your primary residence type real estate, you've got commercial, and inside of commercial, there's a lot of different types of real
Totally.
estate, right? Like whether we're buying an industrial warehouse or maybe an apartment complexes or office buildings.
Yeah.
Um, and would you say that all of those areas of commercial real estate fluctuate together, or do they move at different paces? How does that work?
Yeah, definitely more the latter. I mean, there can be macro stuff that impacts it, for example, like what we've gone through with interest rates, but there's been different reactions, pros and cons, pain points that it's hit different real estate sectors. And so, and this, you can even
Mm.
take this in normal times, is that they're typically are the more resilient commercial real estate sectors that, again, multifamily, industrial warehousing. You're starting to put in there um, certain retail, even throw in like data centers now. Those are, I don't think,
Right.
going away, and that they need to continue to build um, these buildings and these warehouses to house those servers. And so those things will perform well typically in good times, but be resilient in down times, because at the end of the day, people need a roof over their heads, inventory needs to be stored, and the digital, obviously, environment needs to continue to be serviced and grown. But you look on the other side of it, of kind of the more cyclical stuff or the more sensitive, where it's, office right now is having its moment coming out of COVID, other certain retail, even hospitality, that if we go into deep recessions, these are areas that get hit significantly harder. And by the way, this is often typical why they would generate sometimes typically higher returns, because in theory you're saying, hey, I'm going to take higher risk if I'm going to invest in an office building versus in a stable uh, multifamily complex in a attractive city. So this all comes down to kind of expected risk adjusted returns, income people are looking for. And so to your point, when these impacts happen in terms of on real estate, whether for the good or the bad, they can trend in similar directions, but there's definitely a divergence. And so, like, let's use office right now versus office and, let's say, industrial and multifamily. Although there's been this correction to both, office has been deeper,
Hmm.
and its future remains more murky, because people saying, hey, what is this hybrid work environment or work from home? And you're seeing companies that, whether they're embracing it or however they're trying to settle in on what their policy is going to be, there's definitely been this resetting of, oh, we're going to shrink our office footprint. Where there's more office space available because either companies that no longer need it to have people come in, or they've gone a shorter work week and allowed more hybrid. That's going to probably take years to settle out, I think, is what many people are thinking.
Yeah.
Whereas kind of the more stable commercial real estate, again, has moments where it's going through changes, like right now with value, but it's not as kind of long-term concerning because of, obviously, the opportunities that lie ahead in, again, housing, industrial, amongst others.
Yeah.
So,
So in one area that's kind of a point of interest, right, is you mentioned earlier that for some reason, right, even in the high interest rate environment, residential real estate seems to be holding on,
yeah,
especially in Utah. Like a lot of people are like, oh, here comes the correction, interest rates going to go up. But realistically, it seems like there's been a leveling off rather than a continued increase,
yeah,
right? But what that also means is a lot of these first time home buyers, young couples or families or young professionals can't afford in Utah, a 500, six
Right.
hundred thousand dollar home as a starter home. And so that opens up a whole new genre of multifamily, and we're seeing it here in Utah. You guys are based here in Utah, so
Hmm.
that's why I'm kind of leading to this question. Is that a nationwide thing that you're seeing? Is it just in Utah because we've got so many people moving in,
Yeah.
or are you seeing that across the nation?
Across the nation. So you look back just from a demographic standpoint and you say, okay, so a core tenant for many multifamily operators and owners is, used to always be just the millennials, but now you've got the Gen Zs entering in right behind them as they're graduating through college and high school. And so they're entering the workforce. Um, but when you take those two together, millennials and Gen Z, it's like 150 million people in this country. So it's a massive, massive cohort that, to your point, is to say, okay, as they're coming out of college, they're entering the workforce, and whether them wanting to buy a house at whatever stage, but you start to look at that, they are very different than prior generations. Some basic stuff like they're getting married later, which then they're having children later. That's often kind of a trigger for buying your first home. So as you're getting married, having children later in life, obviously student debt is a huge component. Um, and then you factor in just career mobility. If someone wants to move from a Salt Lake to a Dallas to a San Diego, it's just the idea the idea that these millennials, just the younger workforce, wants to have that career mobility. But you take kind of some of those like demographic components, and then you factor in more of the economical, which is home prices that are continuing to be very, very elevated, lack of savings, obviously coupled with the student debt piece. But now you bolt on currently 7% 30-year mortgages, and it's creating the only choice for many of these uh younger workers is that they have to rent.
Yeah.
And so for us, there so much has to happen over such a sustainable amount of time for that to kind of be flipped. Values need to come down, rates need to come down, more inventory needs to be available. um but for now, you're just having so many, because what's interesting about the millennials and the Gen Z, they are very well educated, just historically, just there's more of them coming through higher education than ever before.
Yeah.
They're also very well compensated. So it's this interesting dynamic that if they're graduating college or having the ability to make good earn income this early in life, they're saying, okay, if I'm making X amount and I can't own a home, I want to live in a nice place. This is when you're seeing kind of the evolution of amenities, of location, because you're saying, okay, if I have these higher income earners that want to try to rent, or they're forced to rent and they want to live in a nice location with nice amenities, that's where a lot of the development is now too. And there's a whole nother sector too that's kind of more in the B and the C area of multifamily. It's a wide range, but a lot of groups right now are just seeing such this demand on the the higher compensated side
Yeah.
of kind of the workforce that's being built out. So
Interesting. I think another thing that it's interesting as we talk to some of the younger generation, right? Um, I think there's been, like you said, like a very much a mental shift. It used to be, especially with the baby boomers, the whole idea was you live in the suburbs, you have a quarter acre lot, a nice little home, and you have a single car, right? And there was this like idea of what the family life was like. But as I talk to younger clients and things, it's interesting, and they're like, I don't want a yard. I don't want to have to worry about, all of the upkeep.
the
And
maintenance.
yeah, and so a lot of these places, when we talk about where they're renting, it's almost like they live in hotels sometimes because some of these apartments, complexes, multifamily places, and they've got a pool in the middle, they got a gym on site. Sometimes they have stores on the bottom,
Too.
and it's this kind of a really different idea of what life is, I think, compared to some of us older folk who still, subscribe to the idea of living in the suburbs on your little lot in your neighborhood with your neighbors. And
Yeah.
it seems like there's a real shift that way too, as far as what they want versus, in addition to the supply and demand of houses.
That's right. I mean, I guess that's what's the interesting kind of, to use your term, shift, is that from the baby boomer side of it, that just obviously have seen such massive appreciation on the values of those homes over the past many decades. And then you've now seen, again, there was a pretty significant correction in homes, obviously, in the great financial crisis. That hasn't necessarily impacted here today, just because, again, houses are better capitalized. There's not just people aren't just completely over levered on their homes, and people are locked into great rates. So it's holding up that value, but you still have just tens and tens of millions that would say, hey, I need a home. I need a roof over my head. And so to your point, if I can't afford or no longer, I don't even want to live in that suburb. I want to live more near where I work out of, or where the nightlife is, or whatnot. So to your point, the amenities now, like when we grew up, the idea of, okay, a nice apartment would be if I have granite countertops
Right.
and stainless steel appliances. I mean, that's luxury as it gets.
Yeah.
And now it's like, no, you have to have, again, for what you're trying to cater to, resort style swimming pools, state of the art fitness center. Staples now are a dog park on property, bike washing stations. But then also you need things like that. You have to have like Amazon drop off solutions, because think how many Amazon boxes are dropped off at a 400 unit apartment building. You don't have that driver roaming out through you have to have a solution kind of at the entry. So again, so a tenant that comes in that says, oh, I see you guys actually have a plan. You have a huge room that's where I can drop off or pick up my Amazon orders or my returns. It's like coming up with all these solutions. So someone's like, yeah, if I'm going to pay to live here, that I really do enjoy the amenities and the efficiencies that you guys create for me. That wasn't like it was 25 years ago.
No.
Where it was.
No. In fact, I've asked them, where are you going to put your boat? And they're like, I don't have a boat. I don't want a boat, or old cars that you fix up. So it's just definitely a new thing, which I think is fascinating. I love going to nice resort type hotels, obviously, but living in one to me seems just a little foreign, but I can see the draw for sure. Hey, if you like what you see or you want some additional information, go to our website listed here below, wheelhousewealth.com. Get in touch with us. We'd love to answer any questions you might have.
Yeah.
So one other question that some people have asked is, you hear in the news, and maybe it's just because of our location here in Utah, but you hear in the news, everybody's leaving New York, they're leaving San Francisco, LA, and they're all coming here, right? And of course, it's not just here. People are going to Texas and Nashville and Florida. I think Florida's the highest right now. But so they're leaving kind of these big cities, right? What do you guys, is that just us kind of being a little, I don't want to say afraid, but just seeing the amount of people coming into Utah and saying, kind of making an assumption? Or are you guys seeing a trend across the nation where, hey, people are leaving the big cities and they're coming into secondary or tertiary cities?
Yeah, no. So like you said, when it's on a short clip news story, whatever it may be, it's often more hyperbolic than it actually is. But for us, there's absolutely migration shifts happening all over the country. And this is stuff that companies like us track, because us or any of our colleagues are looking, hey, where do we want to buy and or build future residential units? And so that's often driven by kind of where the masses are moving to. So when you look at kind of the coastal cities or the primary markets, yeah, there definitely is kind of a net migration coming out of those, and those are being infilled into places like Salt Lake or a Nashville or a Charlotte. You can go into other cities, but it's nothing to where these places are being a shell of themselves, and the cities that are gaining those transplants are being overwhelmed. At least in some moments there was that in COVID, but kind of the way I look at more primary versus secondary market is, so the reason you're seeing such Salt Lake's a good example. Salt Lake, first off, Utah's a business friendly state to work out of. It's an educated state in terms of just in the Salt Lake Valley, all the universities that are within X amount of mile radius.
Yeah.
Good infrastructure, good quality of living, relatively good cost of living comparative to the coastal cities. So what that does, you kind of factor all that in, and often population growth is driven by job growth. And you obviously know that here. The companies that continue to either transplant here, expand here, create here is a magnet for people to move to. And so, and that's for us, what we like to kind of track, and when I say us, even kind of commercial real estate developers would say, hey, if I am on the residential side, I like the idea of a city that's seeing outsized population growth, more people moving in that are moving out, coupled with, they're undersupplied on homes, whether it's single family home or multifamily home. And so, and the reason is these companies can create jobs here and say, I can pay this 28-year-old X amount in a salary, and they can live here because cost of living isn't so outrageous. versus if I had to keep that same person hired and I hired them in the Bay Area or in
Yeah.
Seattle or in New York, wow, am I going to have to pay them double or 2.5 times? And so you're seeing that kind of shift happen all over, whether it's the Salt Lakes, it's what Denver went through years ago, Austin, Texas, Nashville, Charlotte, is you're seeing this migration of people that are often driven by the job creations that are happening in those attractive markets. And so thereby, by design, groups like us kind of track that activity and lean into it.
Gotcha.
Yeah.
So Utah still is, I guess Salt Lake could be considered a secondary market,
Yeah.
right?
Yeah. You're right. It's a relative term. Like to me, primary are the gateways often. New York, LA, San Francisco, even though I know it's gone through a moment. Seattle, I'd probably throw Miami in there,
Yeah.
maybe Washington, DC, but then you kind of get that the secondary market is much broader. Salt Lake, sure. I'd even throw Denver in there, Dallas, Austin. I know they probably take offense to this. These are large cities,
Yeah.
but it's not a locked in
It's
definition.
not a Tokyo or,
That's
the,
right.
the
Yeah.
big, the big names
Yeah.
out there, right?
So
Interesting. And do you guys think, I mean, I know you guys study this stuff, but is that a trend that, because companies, I think with technology, they're becoming more flexible. You can have people working in different cities a lot easier, or they can transplant the whole company easier
yeah.
if they want to. Is that a trend that you guys think is going to continue, that you'll see kind of the big cities continue to, I don't know if the right word is lose, but a lot of people are going to be moving out, companies moving out of these cities because they can get things at half the price in a secondary city?
Yeah, it's so hard to answer that in terms of kind of long-term sustaining issue because yeah, I mean, for me, there's an appeal to these primary cities for different reasons, whether it's just uh, things from job opportunities that are there to just um, their perceived quality of life, weather, just all kinds of things that I don't think you're going to, people thought San Francisco was going to just collapse and it's not. And you're starting to see a recovery set back in as kind of things reset. So what I think what's going to be interesting to better answer your question is kind of, it still needs to be worked out in terms of how companies truly are going to settle on what they do with their workforce, whether
Yeah.
they're saying, because I think there's definitely been a signal that there's a rejection for many, not all, but many on this completely work from home. Everyone just work from home. No one ever has to come in again. And they realize that that's maybe not the best way to go. So now you're seeing a more forceful, like, okay, well, maybe you have to come in 3 days a week. And that probably hasn't even settled in yet either. So to point is, I don't think you're going to see these like mass exodus to say, okay, that's it. We're going to move everyone remote. We no longer need this building in LA and we just saved a bunch of money. I think that's oversimplifying.
Yeah.
But I also think there's something to it that companies are going to kind of continue to tweak and modify how they hire or how they require their employees where they need to live or where they need to come into work. And I think it's going to take years for that like, kind of to continue to kind of shift into whatever new frontier we're going into in that front.
Right. Which will always be
So,
interesting. I just, I think I've read a couple of studies that said productivity does fall when people work from home. And it's just kind of like common sense, right?
for sure.
The fridge is closer, the dog's there,
Easier to be distracted.
Yeah.
So you don't get kind of the brainstorming going if you're in there with more of your colleagues, kind of just it. Yeah. It's interesting kind of to see how this is all trending.
trending together.
Yeah.
Awesome. So overall, I mean, I really appreciate you kind of maybe expounding upon some of these things that are happening, because I think there's a lot of people out there saying, hey, rates are high and, how does this affect that? And we're hearing, they're hearing that there's problems in commercial real estate. And I think a lot of those have been over exaggerated. But if you were to say from your firm's standpoint, I mean, you guys invest across the nation, right? It's
Mhm.
not just Utah, you're headquartered here, but you invest all over the country. What's your outlook for 1, 3, 5 year for real estate?
And I think those are always important ways to look at it because what's been so interesting with what interest rates did is so many people got so fixated on kind of shorter term kind of yields to say,
Yeah.
okay, this is what I can get in a 1 month or a 3 month and a 6 month and a 1 year, which I don't argue with. Rates that went up that made all of a sudden risk-free treasury CDs a lot more attractive than where they've been over the last couple decades.
Yeah.
But as rates do start to come down and advisors like you, or even companies like us, amongst others, we're trying to kind of position ourselves for, hey, if we're putting money to work for the next multiple years, we're not trying to do something for the next 6 months. And so to your point, we're long-term investors, typically commercial real estate owner, operator, developers are. And so for us, kind of what we talked about, the 1 year, and again, we're all just reading tea leaves here,
Yeah.
but assuming the Fed is done raising rates, it's to say, okay, this next year is probably going to be the space where things do really start to stabilize, assuming you have good assets, good market, you're a good operator, you're not dangerous levels on your debt, you don't have
Yeah.
massive refinancing coming due, those types of things, to say, okay, this next year is kind of the year where things can hopefully start to stabilize and we can start to build that foundation for that next part of the cycle, which is what we talked about, is the Fed, when they do start cutting, they're not going to, I don't think, cut significantly or relatively or so fast, but as
Yeah.
they start to come down, it starts to create the recovery environment for commercial real estate for kind of the correction they just went through. So you kind of take that 1 year kind of space for more of a stability component, and then you get in, 3 years from now, it's likely, hey guys, we're into the recovery now, and that
Yeah.
we see opportunities, whether us as the operator or or developers that are looking to build. We're kind of in that recovery in kind of the 3 year window, and then you kind of push out 5, which again we're looking out far, is to say, hey, historically speaking, if now we're kind of in just a sustained performance, to say, assuming the Fed hasn't had to plummet rates, they haven't had to
Jack
increase
up.
them back up, because that changes everything.
Yeah.
But if things are kind of more of in a stable environment, normalized interest rates, that it wouldn't be crazy to say, yeah, 5 years from now, just kind of what 2010 or 11, where were we in 2015 or 16, was a very well sustained, well-performing commercial real estate environment. So that's where we hope it's kind of leaning to or heading to, but knowing we have to be flexible and adjustable along the way.
Yeah. I mean, the age-old saying, right? Past performance is an indicative of future
course.
results, and especially where it's so interest rate sensitive, and different administrations and different philosophies can really, I guess, probably, have a hand in that,
Mhm.
right?
I mean, if the Fed all of a sudden decided to go back down to zero, that would likely bode very well for commercial real estate
Yeah.
in the short term or relative short term, because all of a sudden you have that kind of different impact of, as rates are going up, it brings values down. But not, I don't think groups like us want that. You don't want that
Yeah.
creation of kind of the boom and then the bust and the boom. And so if we can get to kind of more normal environment, it's what allows these kind of periods of stability into recovery, into sustainment, last much longer, which
Yeah.
is what we love. Like groups like us, commercial real estate is, we want to own it, operate it, deliver results, for long-term, sustained performance, not kind of boom and bust.
Right. And I think, in my opinion, I mean, because I think the most recent one, I think you alluded to it earlier, or was the most recent real estate correction, was just after '08.
Yeah.
And that was more of a burst of a bubble. And it was because the lending was so aggressive. There was these funky loans, but a lot of people are over levered. Maybe they got a loan that they really shouldn't have had in the first place,
Yeah.
right? And so that was more of like, when the bubble pops, and it's just more, I guess, abrupt, right?
Mm.
But even though the headlines in the news are saying, hey, there's all these issues, I don't see that even in commercial real estate, where all of a sudden things are tanking. It's just been more of kind of a leveling off, some trouble, adjusting to the interest rate environment, but coming out of it, it looks a lot more stable as well.
Well, yeah. And that's the big difference. What 2008 and 2009 is just, there was just such this mass over leverage, not just at company levels, but in personal levels. People that were
Yeah.
just, again, taking out their HELOC, just having just very little equity in their home, thinking, oh, this is just easy. My home values just keep going up. That obviously came crashing down in the great financial crisis. And so that's nothing like what we're having. People have way more equity in their homes. They're again, speaking in broad terms, are just so much better, well capitalized. And you haven't seen this just domino effect where home values all of a sudden just collapse, which then all of a sudden creates massive, an environment for just a very deep recession that we went through. And so for us, on the commercial real estate side, it's kind of the same ideas. You understanding that you're going to go through kind of the ups and downs of an economic cycle. For us, it's hey, if you can keep the ability to have occupancy full, that's critical to say,
Yeah.
okay, and that's driven by supply and demand. If I own in markets where there's not just so many options for people to live, so many homes to buy, so many apartments to rent out. If that's the case, then that puts downward pressure on occupancy. And that's what often makes groups commercial real estate. All of a sudden you have to start lowering your rents to try to bring them back in. So if you're in markets where your occupancy is staying full because of the supply and demand disconnect, that's something that we're in all over this country. And then the idea is to say, hey, if I can keep my occupancy full, if I can be an efficient operator in terms of controlling my expenses, growing my revenue through whether I'm an office tenant or a multifamily, that I can grow my rent incrementally, that you can weather so much with that, assuming the other piece of it is that, yeah, you're not at some dangerous high level or irresponsible side or on the debt side.
Yeah.
To say if I'm so highly levered or if I'm using just very interest rate sensitive debt instruments like floating rate debt or whatnot, that kind of changes the equation or can change the outcome. But if you truly are saying, okay, I'm going to be at moderate levels of debt and I own good assets in good markets that we believe continue to has the ability to stay occupied and grow our rents, that's how you create the long-term sustainability. And you say that there's some that don't do it that way, some that do kind of maybe reach for that higher risk, higher reward. And it's in cycles like this that maybe they don't survive, and it creates opportunities for others that were kind of a little bit more responsible or a little bit lower risk.
It goes back to that age-old saying. I think it was Warren Buffett who said this, but he said when the tides are high, everybody's having fun swimming, but when the tides go out, you find out who's swimming naked.
That's right. So it's, and there you go. And whether that's every 10, 12 years on whatever asset class or area you're talking in, but you're right. You saw that classic high tide environment, and then we've seen that tide go out. And it's, for many groups, just again, the long-term investors that just kind of gone through multiple cycles. I think that's another thing is just experience is critical. And that you just know to say, even though times are so good right now, I don't need to reach for that extra level, and allows you to kind of to hold up during these pieces, and then opportunities come on the other side. And so, yeah.
Good. Awesome. So if I'm understanding it correctly, you're excited. You think this is a good times are ahead, hopefully.
Exactly. But we're seeing kind of what the Fed speak of saying, hey, we're likely done raising, cuts will likely be coming or could be coming, however language you want to use, this year and into next year. Again, this is going to be over multiple months, even multiple years as they start to think they'll bring them down. And that's, again, a moderate declining interest rate environment historically bodes well for commercial real estate operators. So for us, like anyone else, it's to say, hey, if I like an asset class that just went through a semi-infrequent correction in terms of its kind of value placement, and I want to own something like that long-term, like what we do when we buy or build, it's the idea is to say, hey, these things are on a cheaper value than they were 12, 18 months ago. And that's often opportunities that would come and that we want to take advantage of.
Awesome. Yeah. Well, Jeremy, I really appreciate you spending some time and maybe shedding some light on, commercial real estate, what's going on even nationwide, and kind of filtering through the news headlines, because I think a lot of times they aren't necessarily the most transparent as far as what's really going on. Let me ask you one more question, if you don't mind, and that is, as far as what's happening in real estate now, is there anything that you feel like people should know that I haven't asked about?
No, we've covered a lot. You hit on something that I think is so important is that, so when people often want to kind of generalize, let's just say real estate, we can do this in many other sectors, but they want to generalize it just national.
Yeah.
Like the national real estate environment, which is just not serious. Real estate is local, and this is on any type of asset class in different city. What you're trying to ultimately allocate to, or ultimately try to execute on a strategy, is that I think what's so important is to understand, okay, let's start with the asset class that I like, the strategy that's being deployed, but then also the market that it's being put in. Because again, if I'm looking to go build a real estate portfolio in a certain primary, and let's just throw out a market, like San Francisco, which has gone through a lot of, just weathered a storm that it's gone through. But I think you're right. Everyone says like, oh, is there even a person in San Francisco anymore? Versus it's not as bad, but also it's been real. There's been a significant a correction there, but it's to say, hey, is that something that I want to try to take advantage now, or I want to let that weather? Versus if I was going to go buy something or create it in Grand Junction, Colorado, there's a whole different environment there in terms of economy, population, opportunity. Or do I want to kind of go, that's a tertiary market, or do I like the idea of kind of splitting it in the middle of a Salt Lake or a West Palm Beach or a Tampa or whatnot? And so I think that's the idea, is for people to say, I want to own real estate. It's like, okay, well, there's a few other questions you should want to ask
Yeah.
to really understand kind of, again, what am I getting into? What's our strategy? What's the long-term prospects of that market? Because you could even see, that Salt Lake is not just Salt Lake.
Yeah.
It's just like, oh, are we talking on the west side of the valley, the east side? Are we talking north? Are we talking point of the mountain? I mean, it's all different kind of just sub areas of these cities that can have an impact on what companies are trying to achieve. So that's, I think, just what's also important too, is that not always just speak in such general, like you said, the news it's easier for them just to speak in general terms.
Yeah. And if it bleeds, it reads. So they tend to have headlines that,
but I think it's good to create the kind of the thought that, oh, that's an interesting topic. But if I want to kind of dig a little bit more, I think that's always kind of a wise way to go, just versus, taking that article or story at face value.
Well, and a lot of times I think to that point, the people that write the articles are not real estate experts.
Yeah.
They talk to somebody and they write up their understanding of the conversation, but they're not necessarily in the market as deep, doing it every day, right, as somebody else would be. So, but I think we're fairly optimistic about the real estate market, especially in Utah. Like I said, we haven't seen a lot of corrections either on the residential side. On a lot of the commercial real estate, it actually seems like it's holding in there pretty well.
It wouldn't surprise me relative to other cities. Again, back to my point,
Yeah.
different cities, different outcomes. And Salt Lake, I mean, Utah was one of the fastest growing states based off the last census. It's expected to be it again in the next 10 years. So this is classic stuff where, again, companies and for whether creating jobs or groups like us that are looking to develop into these cities, it's kind of seeing those longer term trends, because that's what it's built on. We're long-term investing is much more what often groups like us are interested in, versus the idea of kind of quicker turnovers.
I'm going to go and make a pop and I'm out.
That's right. Like an HGTV type environment that I can buy this and renovate it quickly and flip it. That works for a lot of people, but that's not what kind of more our world is. It's more identifying, executing it, managing it, and just being aware of kind of where trends are headed.
Right.
Yeah.
Awesome.